Okay, recording has started. So, chapter 2. Let's start analyzing the transactions and what's their effect on the financial statements. Now, the question is, which are the financial statements? Now, if you remember from the first chapter, the financial statements, we're dealing with the 5 financial statements. One was the statement of income statement. The second one was statement of shareholders' equity, changes of equity. The third one is statement of financial positions. The fourth one is statement of cash flow. And the last one is the note of the financial statements. So very briefly, what we can see on each of those statements before we start preparing them. On the statement of income, we're gonna see when the revenue comes, where the expense is going, is the company have profit or net income? And if there's income, how much is the income? From the statement of shareholder of the changes of equity, we're gonna see how much capital the shareholders contributed in the company and how much company generating through the years as a income. So every time when there's a net income, that net income is gonna go to retained earnings. And is gonna be accumulated there until the shareholder decide to get a dividend. Third statement, a statement of financial positions. Now, the statement of financial positions, what we're gonna see is list of assets, liabilities, and shareholders' equity. The good thing is that we already know the shareholders' equity from the standard of statement of changes of equity. We already know how much is the shareholders' equity. So once we're looking on the statement of financial positions, the other thing that we figure out is what's the assets, where the assets are, and how much liabilities we have, and to where the liability. Assets can be short-term and long-term assets. Cash, short-term accounts receivable, inventory, prepaid expenses. Those are short-term assets. Property, plant, equipment, right of use, intangible assets, goodwill, those are long-term assets. Liability, same thing. We're gonna divide it in 2 categories: short-term liabilities, long-term liabilities. Now, shareholders' equity, as you remember, from the accounting equation, asset is equal to liability plus equity. Once we flip the liability on the other side, it's going to have asset minus liability. That represents the shareholders' equity. Or how much of the assets belongs to the owners of the company after paying the liabilities. The last thing, not the last thing, the fourth thing that left is the statement of cash flow. Statement of the cash flow is going to give us idea, is this company can actually generate cash, and how much the company generate from the operating activities, which are related only and only to the business of the company. How much then generating from the investing activity, which is related to the long-term sustainability of the company. And how much cash coming or going for financing activity, which is the source of cash for the company. The last thing is the notes of financial statements. Note financial statements is the specific reference for each item that you can see on the income statement, on the balance sheet, on statement of equity, balance sheet, statement of the financial position, statement of the cash flow. You can find summary of everything in more details on those notes of financial statements. The last thing that I wanted to show you is the retained earnings. Retained earnings again is the always have the beginning balance, which is carried from the previous year. We're always adding the net income and deducting the dividend. Now I'm gonna repeat again because this is important. One thing you should know, if I'm stressing on something, if I'm repeating something, if I looks like I want you to know something, that means that thing's gonna come, most likely on your quiz. So what's important for me is you to understand how we getting the income. Income is simply revenue minus expenses. And how we getting the retained earnings? And retained earnings is beginning retained earnings in the period. We're gonna add the income and we're gonna deduct the dividend. So in income, you're getting it revenue minus expenses. But in order to get the retained earnings, you need the beginning balance of the retained earnings plus the net income, which is revenue minus expenses, minus the dividend. So if the question asks you for retained earnings, calculate the retained earnings. If the question asking for net income, calculate only the net income. Don't forget the beginning balance, and don't forget to deduct the dividend when you're dealing with the retained earnings. Okay, so now we know at this point we know which are the financial statements. So now we can start talking about the effect on the financial statements. And how those each transaction is going to have effect on those financial statements, which if financial statement is affected first, which one is second, let's keep going, keep going. In order to do that, we have to have some rules. Who set up the rules? I already told you, for the International Financial Reporting Standards, International Financial Reporting Standard Board. International Accounting Standard Board. For the standards which are related to the local standard private enterprises, those are set up by the local standard setters, which is a Canadian Accounting Standard Board. Now, Canadian Accounting Standard Board tells which company, which standards to use. And they're divided. Publicly traded company have to use on international financial reporting standards, where private company and can use in accounting standards for the private enterprises. All the standards, accounting standards, have objectives and concepts. That's the foundation of the standards. Those objectives and concepts are expressed as a conceptual framework, which is developed by International Accounting Standard Board and Accounting Standard Board in Canada. That helps organization to develop their financial report standards, help the council to determine how to account for the item, and help them to assist the users how to interpret financial reports. And those are, we have the fundamental characteristics and we have enhancing characteristics. Relevance is that we can predict it, we can confirm, and there's a free of error. Faithful means information is complete, neutral, and again, there's no errors there. Enhancing is comparable, we can verify it, it's on time, and it's understandable. And obviously, we're going to have constraints. Constraints is always the cost. Now, let's see this one, going concern assumption. Going concern. Going concern is usually financial statements are prepared on the going concern basis. That means we do not expect company to stop operations. In the contrary, we are assuming that the company will continue to operate for the unforeseeable future. So why is that? Because it's essential if the company is to be able to realize its asset and pay the liability in the normal course of action. So there's no distress of the company. We're not expecting the company to close. We have two types of accounting. One is the cash basis accounting. The other one is accrual basis accounting. What's the difference? In the first accounting, we only account and record the revenue when we receive the cash. And we only and only record the expenses when the cash is paid. Now the question is that fair? Well, the accountants figure out that that's not actually fair because sometimes you providing the services and you have delay payment, which may take 1 month or 2 months or even 3 months or even sometimes 1 year. The question is, did you provide the service? Yes, I did. Now, the fact that you haven't received the cash, it doesn't change the fact that you earned the money. Same thing with the expenses. You're using your cell phone, but you're not paying until next month. The fact that you're using the cell phone, it's a fact. So we're gonna record the expenses based on the fact that you're using cell phone, not on the fact that when you're paying the cell phone bill. Make sense? And that's the difference between the accrual basis and cash basis. Cash basis, the simple you can understand it is cash is we only recording transactions which are paid in cash. With the accrual basis, we don't care when the cash is received or when the cash is paid. We're looking at the nature of the transaction. Did we earn the money? Did we use the expenses? And that's how we're recording it. Now we're going to the revenue recognitions. Revenue recognitions have a 5-step process under International Financial Reporting Standards. Under accounting standards for the private enterprises, there are only 3 steps. But in general, company recognizing the revenue when it's actually earned. It's very important you to understand that recording the revenue is the crucial part. Why? Because the recording the revenue is gonna make the difference between am I generating net income or not. As you can see on the income statement, that's where the revenue expenses are. That's why we're talking too much here about revenue expenses. If I'm using cash basis accounting, I'm gonna get one net income. If I'm using accrual basis, means that I don't care about when cash is paid and received. I care about is the revenue earned and expenses used. Then I'm going to have completely different net income. The question is, which net income is more realistic? And which one is going to help the users of the financial statements to make better decision? And usually those users, they want to know not when you're paying, but they want to know how much you have to pay. In that case here, if we're using cash basis accounting, we're never going to have accounts receivables and we're never going to have accounts payables. So technically here, our short-term liability will disappear because we only show the expenses when we actually pay cash. Where in accrual basis, we're going to have accounts payable. And here on the revenue, we're going to have accounts receivable. Why? Because we provided the revenue, but we didn't get the cash. In expenses, the same thing. We used the expenses, but we didn't pay our suppliers. So the revenue, so that's why it's important you to know where to record the revenue. Revenue is recorded and recognized on the financial statements when all the 5 steps of the process are met. In general, company recognize the revenue when it's earned. Means that if you're providing the services, when you actually provide the service, not when the client pay you. If you're selling merchandising, when you sold that laptop to the customer, not when the customer pay you the money. Now, the basic accounting equation, we already talked about it. That's asset equal to liability plus shareholders' equity. How can I interpret this equation? In so many ways. Asset is the capital that we need to run our company. Then somebody asks you, from where did you get your capital? Well, I have investors, which you can see on the shareholders' equity, and I have creditors, which you can see on the liability side. Then we can talk about what's the capital structure of your company? Well, that will be very easy now. How we can get the capital structure of the company? Well, let me go here, try to add something. Usually the assets always represents 100%. Then the question is, what's on the other side of the equation? What's the percentage of the liability? And what's the percentage of the equity? Now, liability and equity have to be equal to 100. If the assets are 100%, obviously the liability in shareholders also should be equal to 100%. So let's say if the liability is 20%, the equity should be 80%. Or if you know that the equity is only 60%, then you of all the assets, then you know that liability are 40%. And when somebody asks you, what's the capital structure of your company? You can tell them, my capital structure is 60% I'm financed by equity or investments, and 40% my company is financed by the liability or creditors. The other thing that I want you to remember always is the net assets. And the net assets are equal to the actual assets. Net assets are actual assets minus the liability. So in other words, the net assets are equal to equity. That's how you should remember it. How to calculate the retained earnings? Now we could coming again to retained earnings. Again, if I repeat something so many times, that means it's important. Retained earnings, always remember, we're going to have an opening balance for the retained earnings. Then we're going to calculate the revenue minus expenses, get the net income, and we're going to add the net income to retained earnings.
Professor,
Yes,
I have a doubt in the previous slide.
let's go with the previous slide.
Can you explain the last terms like 100% equal to 40% plus 60% with an example?
With example.
Yes.
Okay, let's example in class. What was the example in class? We buy a house, right? How much we pay for the house?
Mm, approx
Give me a number.
5%.
No, 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 no. We bought a house. What's the value of the house?
5,000 something, maybe.
Let's go with 2 million. 500,000, you won't be able to get anything here. It's
Oh,
Vancouver people. So we get the asset, which is house. Make sense?
yes,
Now,
Professor.
now we have the asset on one side. Which asset is 100%? Now the question is, what's on the other side of the equation?
Liabilities
It can be
means
liability. Imagine we have cash, $2 million cash. We just win the lottery. Can I pay cash for my house?
no.
Why not? I have the cash. I just won the lottery,
Okay, Professor.
right? Can I pay cash?
Yes.
Yes. So how much will be my liability? Zero.
Zero.
Zero. And how much will be I'm gonna invest in my house? The entire amount, $2 million.
Okay. So,
$2 million. So what's happened in this case? How much is my asset? Asset is 100%. How much is my liability? Nothing.
zero.
How much is my investment? 100,
100%.
100%.
Okay.
That's if we have $2 million. But let's say we don't have the $2 million. We have only 10%. So what we have to do? I have to deduct the 10 and change the decimal. I'm gonna pay only 200,000. Now the question is, if I'm investing $200,000, how much I have to borrow? Because I want this house, and the house is $2 million. I'm investing only 200. How much I have to borrow?
1,800,000.
1,800,000.
Yes.
And now we're going to the percentages. Now,
10,
how much is my equity?
90%.
90% it will be my liability,
Liability.
and the 10% will be my equity.
Oh,
Make sense? Why? Because the house is always, whatever asset you have, that's always 100%. The question is, where did you get the money?
okay, Professor.
Did you get somebody to invest, or you went to the bank and asked for credit? Obviously, let's say let's pay 1 million. We found the money, we pay $1 million. How much will be my liability now?
1,000,000.
1 million.
1,000,000.
What will be the percentages now?
50.
50, 50, 50, right? That will be the easiest way you to understand it and the easiest way you to see it and feel it. Remember, whatever you get, it's always 100%. So imagine this: you're going to the store. You saw this jacket. You want it, but the jacket cost $200. So what are the options here?
We can
I
pay directly
I can pay
200.
directly for my money $200, or I can still pay $200, but now I'm gonna borrow it from the bank, right? And I'm paying nothing. So my jacket will be 100%, right? I have it. Now it's in my hands. How much my liability now?
100%.
100%. How much I pay for my money? Nothing.
0%.
Make sense?
I, yes, Professor. Thank you.
So when you decide one day you decide, okay, these guys I have to pay them those $100. What's gonna happen? Now those $200 gonna go to zero, and then you have to pay. So what's happened now? I don't owe any more money, but I pay for my money. So this jacket now is mine. Make sense? And you can
Yes,
put this one for everything, for everything. Let's say you want to buy a book. You want to buy a Wiley book for this course. And how much the book cost? I saw like a $99. And let's say $100 is the book. What are the options? What options you have now? Either you're gonna pay with credit card, which you have to pay later, either you're gonna pay with your own money, correct?
So what's the difference? We should pay for liabilities later too.
You have to clear the liability. Nobody's gonna leave you without liability to live with the liability, right? Because when
Yeah.
you borrow the money, the people want those money back.
Yes.
Credit card wants the money back. Bank
Yes,
wants the
exactly.
money back. Make sense?
Yeah.
So how are you gonna get the money? Well, you have to generate them.
Mm-hmm.
Now the question is from where the equity is gonna come. And that's why we come in here. Well, equity comes from the revenue minus expenses. So every time when you have a net income, that's going to increase your earnings. That's why you're going to work. What you're
Yes.
getting when you're working, you're getting revenue. Make sense?
Yes.
The only thing that you have to make sure is the revenue is more than expenses. Imagine this now. You're buying the book for $100. You don't have equity now. So I have to borrow $100. So now my liability is 100%. My equity at this point is zero.
Zero. Yeah.
So what do I have to do? I have to go to work. Why? Because I need revenue. But I also have to live. So I have to pay my expenses. What do I have to make sure? I have to make sure that whatever I earn is more than my expenses, at least with $100. So I can pay for my book. Otherwise, I won't be able to pay for my book. Make sense? So I have to earn income. Once I earn income, that's going to increase my equity. And from my equity, I can pay the liability. And then the liability is going to go zero and the equity is going to go 100%.
100. Yeah.
So I close my liability, but now I have my book. Make sense?
Yeah. Thank you.
And the last thing that on the retained earnings you have to remember is once you add the income to the beginning balance of the retained earnings, whatever it is, you have to deduct the dividend. Now, the key here is when it's the brand new company, since they're just opening, they won't have beginning balance. Why? Because they didn't work last year. So when the company starts, retained earning is zero until they generate income. Once they generate income, that retained earning increases. Once the owner asks for dividend, that decreasing the retained earnings. At the end of the year, we're going to see how much is the income minus the dividend that the owner get. That will be our balance. So the next year, that will be our beginning balance. And the next year, we're going to see how much income we're going to generate, how much expenses dividend we pay, sorry, dividend is paid, and that will be our ending balance. So now we're going to start doing transactions, and now we're going to start seeing how the whole thing works on one spreadsheet. So first thing is we're going to have our assets, we're going to have liability, we're going to have equity, and we're going to have revenue expenses and dividend. Assets, we're going to have cash, accounts receivable, inventory, prepaid insurance, equipment and land. On the liability, we're going to have accounts payable, interest payable, bank loan payable. On the shareholders' equity, we're going to have common shares, retained earnings. And then we're going to have revenue, expenses, and dividend declared. Now, in order to record those transactions, we have to keep it very, very simple. Means always when we're doing transactions, asset has to be equal to the liability plus equity. Same thing that we're doing here, examples with the house, with the book, with the jacket. What's on the other side? The same thing has to be on the other side. Why? Because we are in balance. It's equation. I cannot have a jacket for $500 and here nothing. That doesn't make sense. It has to come from somewhere, right? Either it's going to come from liability, either it's going to come from equity. So once we keep this equation in balance and intact, everything is good. Now, before I start with this, what I'm going to do is I'm going to share another screen with you. Just a second, just give me a sec. I'm going to share this screen with you. Can you guys see my screen?
Yes, Professor.
So,
Yeah.
this is your screen. This is your bright space. That's where I want you to go. I want you to go right now in the bright space. And I want you to go to this week 1 introduction of accounting. And you're going to see here on the modules, learning materials, you're going to see week 1 notes, complete, Wiley PowerPoint 1, Wiley PowerPoint chapter 2, recording 1, recording part 1, chapter 2, recording the entire chapter. Can you see those?
Yes.
Okay, so watch this. Watch this. What I'm gonna do now is gonna upload a file for you. Okay. And we're gonna start working with that file. Just give me a second to do some changes here on the file. I believe that's the file. Okay. Let me see what you're seeing. Almost there. Okay. So what I want you to do, just watch me. I'm gonna upload this file from my computer. Let's upload it. And that will be here. Can you see it? Now you should be able to have access to it. It says slides template, Excel spreadsheet. Can you guys see it?
Yes, Professor.
Download it. And now let's go back to the slides.
We should download it right now, Professor.
Sorry?
We should download it right now.
Yes, please. Download it right away.
Yeah, okay.
And now we're going to start working with that Excel spreadsheet. So now what we're going to do, we're going to see now transactions of the company. This company starts operations. First transaction that they did, it's brand new company. We just starting business. There's no money, no cash, nothing. So what's the first thing that somebody has to do? Is the owner has to put some cash. Now let's go to that Excel spreadsheet. Once you have it open, I'm going to open it as well here for you. And we're going to start working with that worksheet. Let me see what exactly it is. So, can you see it?
Yes,
On,
Yes,
sir.
on,
Yes, Professor.
Yes, sir.
yes, on
Yes.
January 1st, the owner, the company issued 10,000 common shares because the owner gave the company $250 cash. Now, what we have to do is we have to keep in mind, now we have to start doing those transactions and recording those transactions. The only thing that we have to keep in mind is assets has to be equal to liability and equity. So what we're gonna do, what the company get, the owner give the company $250,000. What the company get? And remember, owner has nothing to do with the company. Those are separate legal entities. So what the company, if the owner give the company cash, what the company get?
Cash increase.
Cash. How much cash the company get?
2,000.
250,000. Okay, let's start putting those numbers. Company get $250,000. Can you see it?
Yes.
Now, did the company get accounts receivables? No. Did the company get inventory? No. Did the company get prepaid expense? Insurance? No. Equipment? No. Land? Absolutely not. Does the company own money? Did they borrow it from accounts payable? No.
No.
Is this interest payable? No. Is it a bank loan? No. Then what is it? What the company
Yes.
give? Common stocks.
2,050.
250,000. Right? Oops, that's too much. That's better. Right? So, once we do that, is this revenue? No. Is this expense? No. Is this dividend? No. Are we in balance? Now, the
Yes.
last column here, it's check. What that means is if I don't put here anything, can you see it? If I don't put here anything, let's say put 0, I'm going to have problem with my check. My check is going to tell me you're off balance with 250. My check always have to be equal to 0. So what I have to do, I have to balance it. Now I'm in balance, my check is correct. Make sense?
Yes.
So what we did,
Yes.
let's go to the slides and see what exactly we did here. We increased the cash with $250,000 and we increased the shareholders' equity with $250,000. Make sense?
Yes, Professor.
Okay, let's do another transaction then. That was probably your first transaction that you did in your entire life. Let's do the second one. Let's get more cash. But now let's borrow from the bank. Let's go back to the Excel spreadsheet. And let's see. Now we additional borrowing 100,000 from the bank. We have to, the loan is 3-year principals with the interest 6% per year. Interest is payable every 3 months. Now, what did we get from the bank?
What 100,000?
But what did we get? Did we get
Uh,
accounts receivable? We did get
mm,
inventory. What we get?
No, no.
Cash. Get
Cash.
that cash. Get the cash. Oops, that's only 10,000. Let's get more. $100,000. That's zero. That's zero. That is zero. That is zero. That is zero. Now, as you can see, we are all balanced with $100,000. From where did we get those? Did we borrow it
Yes.
or
Yeah.
get somebody to invest it? Borrow it.
No, borrowed.
Borrowed, right?
Mm.
From where we get? To whom we have to pay those $100,000 now?
Bank
Bank.
loan payable.
Bank. So that's a bank loan payable. Make sense?
Yes.
Is that part of the shareholders' equity? No,
No, it's
No.
all of them is
not they.
zero.
All those will be zero. Are we in balance? Yes, we are.
Yes.
Professor, what is meant by accounts payable? Like, what is the difference between accounts payable and the other types of payables?
We're gonna come to this. Hold that question for 1 second, and you're gonna see it just in a few minutes.
Okay.
With example. So again, what the company get? Cash. What also company get? Liability. Now company owes the bank $100,000. What's the difference between the first one and the second one? In both cases, as you can see now, in both cases, company get cash. What's the difference between the first cash and the second cash?
The second one is borrow from bank, and the first one is for our own money.
Invested by the owners. Correct?
Yeah.
Second one is borrowed. It means
Right.
liability.
Right. So, question for you. With the first transaction, if we decide to liquidate this company, let's say we don't have this, we didn't borrow money from the bank. Let's say this. We invested $250,000 cash, and we give ourselves common shares. What's going to happen if tomorrow we change our mind and say, no, I'm closing this company. I don't want to open the company. What's going to happen now?
You have to return the money to the shareholder.
I have to return the money to the shareholders. Make sense?
Nothing, I think.
Right? So basically, what's going to happen? The shareholder is going to go get his money from the bank account, and that's it. And the company is going to have zero cash, zero common shares. Make sense?
Yes.
But now we start operating the business. So basically, even though it's a shareholders, even though it's equity, the cash that's sitting in the bank belongs to the shareholder. So we borrowed the $100,000, we have them. Let's see what else is gonna happen. So far, so good?
Yes,
Do-
sir.
Okay. Let's go with the next one. Number 3. Now, we pay rent. We're paying rent, cash. So let's go back to our slides, to our chart, and see how we're gonna show this one on our chart. So let's think first. What is here? We're paying company rented location for 110,000 rent for the month of January. Since January is our first month, we have to pay the rent. How are we gonna pay the rent?
Cash.
Cash. Surprisingly, those landlords, they don't want anything but cash. So let's pay them cash. What's going to happen with our cash? Going up or going down?
Decrease.
Decrease with $1,100, right? Why it's going down? Because we bought something. What we bought? We
I
bought.
can understand when it's decrease and when it's increase.
So you don't understand. So if you get the cash, is the cash increasing?
Yeah.
If I pay the cash, is the cash decreasing?
Yes.
Yes. Make sense? Every
Yeah.
time when somebody give you cash, your cash increasing. Every time when you give the cash decreasing. Make sense?
Yeah. Yeah.
Yes.
I want to start my own business. Okay, start your own business. But I want to rent a place. Well,
It's decreasing.
pay me money and then you're gonna have the place. Make sense?
Yes.
But I want $1,100. Well, pay me $1,100 from your cash, and then you can use my space for whatever you want. Now the question is, did we bought a space?
No.
No, what we did, we just rented it.
Yeah.
What would be that for us?
Expense.
Expense. So what's going to happen? Our expense is going to increase with the exactly same amount, minus 100, $1,100. And now we in balance. Correct? There's no accounts receivables. There's no inventories. Nothing here. Nothing here. No revenue. No dividends. Just expense. We paid the rent. Make sense?
Yes, boss.
Okay. Let's see the next challenge. That was with the rent. Cash going down. Expenses going up. We're going to see this effect on the retained earnings just in a second. Let's go with the number 4, transaction number 4. Now we need to start operations. So we need equipment. We have to buy the equipment, which equipment costs $65,000. And for that equipment, we paid cash. Let's go and do our transactions now on the Excel spreadsheet. Number 4 was the company paid $65,000 to purchase equipment. First thing, what did we get?
Equipment.
Equipment. So what's going to happen with the equipment?
Increase.
Increase. How much?
65,000.
$65,000 equipment goes up.
And decrease cost.
Yes. Why? Because we paid.
Yeah, we paid.
I pay cash. So my
Yes.
cash going down.
Mm.
So let's think about something. 65, that's negative 65. So watch this. If I put here 65 positive, I'm not in balance.
Yeah.
So I have to enter here negative amount. Reduce my cash. Now I'm in balance. So let's think about it. What's happened here? This transaction, or whatever we did, affects only and only assets, correct?
Yes.
So what we did, we convert one asset, which is cash, into another asset, which is equipment. There's no liabilities, and there's no equities. There's no expenses. We just moving one asset into the another asset. Make sense?
Yes.
Yes.
So that's happened pretty much every time in every day in your life, right? You're going around and you're wondering, oh, I want to eat something. And then you're exchanging something, cash usually, and you're getting something. Now, once you buy, let's say, I want to buy a coffee, but coffee costs me $2. So what I'm going to get when I buy coffee, I'm going to get inventory, $2, and I have to pay $2. What's going to happen then? I'm going to start drinking the coffee. So that my inventory will start disappearing. And what's inventory is going to become? Expense.
So your cash will become less.
And cash going to become less. And then inventories become less. Why? Because I'm drinking it. I'm using it. Once I'm using it, expense. Okay, let's keep going with our example. We purchased the equipment, now we have the equipment. So watch this. What do we have now? What this company have right now? This company right now, let's get, so what I want you to do here is, since there's no total line, what I want you to do is highlight it here, go on the top and put something like this, and then highlight everything and use the auto sum function. And you're gonna see, now I have to change the size, the font of the size in order to see everything. And you're gonna see at this point how much cash we have. And I'm gonna copy this, I'm gonna post it here, and I'm gonna have everything on one place. So what do I have? At this point I have 283,900 cash, $65,000 equipment. I have to pay the bank 100,000. 250 belongs to the owner, and I have expense of $1,100, which expense obviously is gonna reduce equity because it's part of the equity here. Am I in balance? Yes, I am. Now let's do another transaction. Let's purchase insurance policy. 1 year insurance policy. Insurance company, they want always and always cash. So we have to pay cash. Let's go now and do that on the Excel spreadsheet. So the company paid $1,800 cash for 1 year warranty policy, covering the new equipment for the period of January 1st to December 31st. Okay. What will be the insurance policy that we purchase? Is it asset? Or is it expense?
It's insurance prepaid
Insurance prepaid. Why will be insurance prepaid?
because we have purchases prior to start it.
Okay, so we bought, so as you can see, we bought the equipment on January 1st. And on January 1st, we purchased that insurance. Now the question is, did we pay for the insurance? Yes, we did. Did we use the insurance?
That
Not
totally depends upon
Yes.
the situation, Professor.
right.
And
And,
we will
and but
call
listen,
another
listen, listen,
installment.
listen, listen, listen. Hold on a second now. On January, this everything happened on January 1st. On January 1st, we bought the equipment, and on January 1st, we buy the insurance. On January 1st, have we used the insurance?
No, not yet.
Not yet.
Not yet,
No,
yeah.
not yet.
Not yet. So, can I show it as expense?
No.
No.
Your
No.
prepaid insurance.
So that will be prepaid insurance. Make sense?
Yes.
Okay. So prepaid insurance gonna go up with 1,800. What's gonna go down now?
Professor, could you
cash.
repeat it?
Yes. Yes. So on January 1st, I bought equipment.
Yes.
Did they start using the equipment?
No.
No. But to ensure the equipment is not gonna break, I'm purchasing insurance for that equipment on January 1st.
Okay.
On January 1st, have I used the insurance?
No.
No, because I haven't yet. You start using the insurance, that's gonna be prepaid insurance for me,
Okay.
right? And how did I pay?
Cash.
Cash. So what's gonna happen with cash?
Minus.
Negative.
Going
Decrease.
down, minus 800. So what I have now, I paid with cash and I purchased insurance. That's all I did. Everything else gonna stay the same. Everything is 0, 0, 0. Make sense?
Yes.
And we in balance. Let's do another one.
Professor, but for this one,
Yes.
so we owe the insurance company every month, right?
No, this is, as you can see, this is a 1-year insurance.
Okay.
So I purchased this insurance to the end of the entire year.
Okay.
That's why.
Got it.
Is the year already passed? No. Did they
No.
use the insurance? No, it's January 1st. So that's why it's
Got it.
prepaid insurance.
Got it. Thank you.
You're welcome. If you have questions, let's clear those questions right away. Don't be afraid to ask me questions. You're not on the camera, so I'm not seeing who's asking questions. I'm not gonna just ask me questions, please. Don't leave anything for later. If you have questions, let's solve those questions now. And don't be afraid to ask questions because probably the other people also have these same questions. Let's go to slides now. We're done with the insurance, right? We purchased that insurance. Let's see the next one. Now, company purchased land for $180,000. Okay, let's go and do that in our Excel spreadsheet. That should be straightforward, right? We purchase land for 180,000 so we can build our warehouse in the future. But we pay in cash. What did we get?
Land.
Increase
Land.
land and decrease cash.
Okay. That's straightforward now, right?
Yeah.
After 5 transactions, decreasing cash and adding land, it's very, very natural and the right seems like a right thing to do. What they have to do now? Only to put minus in front of $180,000. Otherwise, you're not gonna be in balance. Everything else is 0. Okay. Let's get another one. Is it getting interesting now?
Yes, sir.
Yes,
sir.
See,
Professor.
that's the funny part with accounting. First transaction is scary. Second transactions, you still scary. Third transaction, you start becoming curious. On the fifth transactions, it's getting interesting now. Now on the 7, you want to see what's next. Okay, let's see what's next. Now we're purchasing inventory on account. Now we're purchasing inventory on account. Let's stop this one and let's go to our Excel spreadsheet and see what is this on account. So, do you understand the idea of on account? Or no?
No, really.
No.
Yeah.
Watch this. A long time ago, a long time ago, when there was no credit cards, no banks, nothing like that. People still buying stuff, right? Your grandmother, your grandmother, she's still going to the store and buying groceries or whatever she's buying, correct?
Yeah.
Yes. But on that time, probably they will pay only once a month, not every 2 weeks, not on the 15th and the 31st, nothing like that. They're paying once a month. I still remember my parents, paying only once a month. So with the money that they get, they have to live the entire month. Now imagine you're living in a small town. Pretty much everybody knows each other. There's no superstore, there's no Walmart, there's no London drugs, there's no Safe on Foods, there's no Safeway, there's nothing like this. If you want to buy grocery, there's a one grocery store and that's it. So you're going to that grocery store every single day. What are the chances the owner of the store to know you?
High chance.
Very high chances. What are the chances you to know the owner of the store? Very high, correct? And that's how the people are living. They know each other. There's a trust. They believe in each other. I'm shopping in this store, so I have good connection with the owner of the store, and everything is fine. So imagine this. In January, as you know, January is right after Christmas. So on Christmas you overspent a little bit more. So on January 27th, your grandmother start running out of cash. She knows that she's going to get paid on 31st. But she wants to buy, so on the January 28th, you have a birthday. And she has to make a birthday cake for you. But she ran out of sugar. Now she's going to the store and asking, can I buy 1 kilogram of sugar? And the owner of the store, absolutely, yes. But then what she's going to say? But hold on a second, I don't have cash. But I'm going to get my cash on 31st, which is on Friday. Can you give me the sugar now and I can pay you on Friday? What's the store owner is going to tell you?
Okay,
Yes or no? Yes.
Yes, because
Yes.
of trust.
Because of trust. And what else he's going to say? I'm going to put you on your account.
Yeah, yeah. You mean a list, yes, Professor?
Right. So what he's gonna do if you watch the movies, you're gonna see on the stores there was a blackboard back, and he's gonna say, let's say your grandma's name is Mary. So she's gonna write there, Mary, January 27, 1 kilogram sugar, $2. Now it's on your account.
Yeah.
Make sense?
Yes.
What's gonna happen on Friday when your grandma gets the cash? She's gonna go to the store and she's gonna ask, how much I owe you on my account?
Yeah.
$2. That's your $2. Thank you. Right?
Yes.
So what means if we buy on account then? We're not paying.
Mm.
When we're gonna pay? We're gonna pay later. So what that's gonna create? Now we can tell. That's going to create accounts payable.
Mm.
Make sense?
Yes.
Do you understand
Yes.
now where the accounts payable come from
Yes.
and why is called on account? So let's say what did we get? We get inventory, right? How much inventory we get?
180,000.
No. Here. Number 7.
23.
23,000. So we get $23,000 inventory. Did we pay cash?
No.
No.
Then how did we get it?
Account payable.
Account payable.
Accounts payable.
23,000.
23,000 accounts payable. So do you see now? If we pay cash, our cash gonna go down. But since we didn't pay cash, our liability goes up. Now the liability goes up. Why? Because now I have to pay $23,000, which I didn't pay when I purchased the inventory. Make sense?
Yes.
Okay, great.
I have a question,
Yes,
Professor. Actually, we have a equation, assets equal liability plus shareholder equity.
correct.
And why in the line 4 to 6, we didn't have anything in right side of equation?
Because everything happened on the left side of the equation. We're converting one asset into another asset.
I mean, where is our money? Where we get our money?
From the cash.
Um, it's not borrow or it's not our money.
No.
Our
We
own
already.
money.
So watch this. In the first transaction, the owner invests cash.
Yeah.
In the second transaction, we borrow cash from the bank.
Mhm.
Now we have $350,000 cash.
Mhm.
Now I'm start purchasing another assets so I can start operation. Can I start business with only cash?
No.
No. What do I need? I need equipment.
Yeah.
I need something else, other assets, right? So that's why,
Yeah, I got it. I
right?
understand right now.
So transactions, yes, that's a very good question though, because transactions can happen only on one side of the equation,
It could
but
be, yeah.
right? But what's happened here? One asset goes up, the other asset goes down.
Mhm.
Make sense?
Yeah.
So the question is, can the equation happen only in liability? Transactions can happen only on the liability. Yes, it can. What's going to happen now? Let's pretend for a second that I don't want to pay this accounts payable. But what I'm going to do, I'm going to get another loan from the bank.
Yeah.
So what's going to happen now? I'm going to get the loan from the bank, 23,000, and with that loan, I'm directly going to pay my accounts payable.
Directly in the one date, yeah?
Right.
Yes.
So now my accounts payable went down, but my bank loan goes up. Make sense?
Yeah, for sure.
All right. Let's do another transaction now. Let's stop sharing this. Let's move to the slides. Let's go with transaction number 8. Now we sold product to customers for $34,000. Right? We're selling the product to the customer, $34,000. We receive cash, $21,000, and promise that the customer is going to pay us later. the cost of the product was only $17,000. Now let's go to our Excel spreadsheet. Let's see what we're gonna have to do here. On transaction number 8, sold the product to customers $34,000, which 21 was received in cash and the balance was on account. Customer will pay the balance owing on later day. Product was for cost of $17,000. So what do we have to do here? I have to insert a line because obviously I'm going to have two transactions. Transaction 8A and 8B. So what I'm going to show in the first transaction, let's follow the logic and say, let's sell those products to the customers. If we sell to the customer $34,000, what do we have? What I'm actually doing? I'm generating revenue, correct? Finally, I'm generating revenue. I'm generating sales. Make sense?
Yeah.
I'm selling to the customer. So I'm having finally some revenue here. 34,000 revenue.
Mhm.
Now, what did they get for that revenue?
21 cash.
I get $21,000 cash. Finally, I'm getting some cash. Where is the balance? How much is the balance? Balance is 13,000, right? You can see it right here. So what I'm gonna do with the balance? Is this customer's gonna pay me later?
Later
Yeah.
in
Yes.
accounts payable.
Account receivable.
Accounts
Receivable.
receivable, right? Who's gonna pay me? Do I have to pay or I have to get?
I have to
I
get.
have to get.
I have to get. So now I have to receive it, right? So that means that's accounts receivable for me, $13,000. Make sense?
Professor,
Yes.
can you repeat, please?
Yes. So I'm selling to the customer that sells $34,000. Right? Now let's see, what do I get? What did I get first? I get cash, $21,000. And the remaining customer has to pay me later. So I have to receive from the customer another $13,000. Make sense?
Yes.
Okay. Everything else is zero. Now, once I sell something to the customer, do I have to get it?
Decree inventory
So
and
since I get it and I sell it to the customer, now I don't have it, correct?
Yeah.
Mhm.
So what do I have to do? I have to decrease
decree
my
inventory.
inventory. With how much? Is it gonna be with 34?
17,000.
17,000, because that's how much cost me. Make sense?
Mhm.
So
Yes,
it
sir.
cost me 17,000. So my inventory now is gonna go down with 17,000.
And expense.
Expense is gonna increase with 17,000. So how much revenue we generating from this sale only? Well,
34.
once you get 34 minus 17, we're generating 17,000. Why is the 17,000? Because I'm selling something that cost me $17,000. I'm
And I
selling it
should
for
pay,
34. Make sense?
Yes.
Yes.
Okay, great. And it's always going to be like that, right? Once you're selling something, you have to allocate the cost of what you're selling. And at the same time, you have to reduce the inventory because you don't have it anymore. That's why when you sell, always when you're selling something, you have two transactions. One's to record the revenue, and The second one to record the cost of the product that you just sold. So the revenue always gonna go either with cash, either with account receivables, because you need that revenue to come to you. But the cost of the product, always you have to take it out from your inventory because you don't have the product anymore. You just sold it. Let's do another transaction now. Transaction number 9. Company receive $11,000 payment from the customer for the sale made on the account. Okay, let's see what we're gonna do with this. So now the customer that we saw him 30 something for 30 inventory for $34,000 pays us $11,000 cash. What did we get?
Increase cash.
How much?
11,000.
$11,000 cash. From where did we get that cash?
Decrease account receivable.
Customer pay us, right? So now we have to decrease his balance. Does he still owe us money?
Yeah.
Yes. How much he owes us?
2,000.
$2,000 more. Make sense? He's supposed to pay us 13, he pay only 11. And we're reducing his account with 11,000, so but we're keeping on his account $2,000 more. And we want those $2,000, but let's see if he's gonna pay us by the end of this question. Everything else is 0. Okay, let's do another one. That will be number 10. What's happened now with number 10? Company make a payment to the supplier for the inventory that we purchased before. Payment is for $13,500 cash. So what's going to happen here? Same thing that happened before, but now we're not getting money, we're paying money, and we're closing our accounts payable. Make sense? How much did we pay?
Yes.
13,500.
13,000.
What's going to happen with our cash?
Decrease.
Decreasing.
Minus 13,500. Nothing here, nothing here, nothing here, nothing here, nothing here. What's going to decrease now?
Decrease account
Accounts
payable
payable.
for the suppliers.
All right. Our account is going to go down now with 13,500. Did we clear our account?
Not yet.
Not yet. How much we still have to pay?
9,500.
Now 1,500. Okay, let's do another one. Number 11. What's going to happen now with number 11? Company paid monthly utility costs for $1,900 cash. So the electricity bill came and we have to pay $1,900 cash. How are we going to do that?
Decreasing cash.
We're going to pay $1,900 cash. And
Expense.
Expense.
we're going to increase the expense minus 1,900 expense going up.
And it will get less by $1,900.
Correct. That's correct.
Professor, each time we make an expense, we have to add a minus, right?
Minus, yes. Because the expense reducing the shareholders' equity.
Okay. Thank you.
Revenue increasing it, expenses reducing it.
Yeah. Thank you.
So let's see the next one. Next transaction. Company paid advertising cost $2,200. Well, that's kind of similar transaction to the utilities, right?
Yeah.
So what's happened here?
Decreasing cash,
Cash
2000.
going down,
Yes.
two minus 2200. Nothing here, nothing here, nothing here, nothing here, nothing here,
An
nothing.
expense.
Expense is going to be affected only by reducing retained earnings or shareholders' equity. Minus 2,200. And we're done with this. Let's go another one. Now, next one. Now we have to pay our employees for the month of January. And we pay them $2,900 wages. Let's do that. How are we going to pay them?
Cash.
Cash.
Decreasing cash.
$2,900. And what we're going to increase now?
Expense.
Expenses with $2,900.
Why expense?
Increasing?
No, why expense?
Well, what was going to be? Did we use the employee?
Yeah, we
Yes,
use.
we use the employee, right? So if you use something, that's expense. Did we use the utilities? Electricity?
Yeah.
Expense.
Uh,
Did we
yeah.
use the advertising?
Yeah.
Expense. Did we use the employee? Expense.
It's
Yes.
like using the resources, right?
Exactly. Now let's see another transaction. One more to go. Dividend of amount of 400 were declared and paid to the shareholders. Cash. Let's do this transaction now. What the shareholder get?
Cash.
Cash. So if they have it, that means we don't have it. So we have to reduce our cash. $400. And what did they get?
Dividend.
Dividend. Which dividend is going to reduce our shareholders' equity. So minus 400 here. And we in balance. Let's go with another one. Now, the other one will be, watch this now. Do you remember this equipment that we purchased?
Yes, sir.
So we purchased this equipment. I'm going to open a new Excel spreadsheet here, and I'm going to put it here. So we purchased this equipment. Now we're planning to use the equipment for 6 years. We're going to use this equipment 6 years. So over the 6 years, we're going to generate revenue, correct?
Yes.
Right. So every time when we using the equipment, we have to show the expense. Make sense? Because
Yes.
if that equipment give us a revenue and we're not showing the expense, we're gonna end up only with revenue. But actually we're using the equipment. So if we're using the equipment, you have to show the expenses related to that equipment. The question is, how are I gonna get the amount of the expenses for that equipment? Well, if I have 6 years to use this equipment, which cost me $65,000, what I'm gonna do? I'm gonna prorate those $65,000 over 6 years. So what I'm gonna get? I'm gonna get 65,000 divided. That's 650, 65, 1, 2, 3. 65,000 divided by 6. And what I'm gonna make sure that every year I transfer as an expense, how much will be that?
$10,833.
So that will be equal to this one divided by 6. 10,833. Every year I have to make sure that I expense this amount. But since we're working month by month, I have to expense this amount every month, right? That's how much will be for year. That will be per year. Can I convert it to month?
Yes.
Yes, sir.
How can I do that?
Divided to
Divided by 12.
Divided by 12. Okay, let's divide it by 12. How much will be per year? Per month. Let's go here. This one, copy this one. Now we want it per month. So what do I have to do? I have to get this number that will be equal to this amount divided by 12. And I'm going to get it per month. And that will be $902 per month. Make sense?
Yes.
Okay. So we have to, every month we have to show expense from $902.78. Now in our question, they're showing something different. So what they're showing in our question is on the slides. This is the scenario if we don't expect to get anything from our assets at the end of the life of the asset. Make sense? But in the questions on the slides, what they're saying is, I purchased this equipment for 65. I can use it for 6 years. And at the end of year 6, I can sell the asset, equipment, and I can get $3,500. So now the question is, how much is the actual cost that I have to transfer as expense over the life of the asset? Is it going to be $65,000? Or is it going to be $65,000 minus $3,500? What do you think?
The second choice.
The second choice. So what I have to do here, I have to add minus $3,500. And if I do that, my calculation changes here. So why? Because I'm going to have 65,000 minus 3,500, that in bracket, divided by 12. Sorry, by 6. Make sense?
Yes.
So sorry,
Professor,
no.
can you?
So no,
Sorry.
no, they're using not 3,500, they're using 3,800. I want to be exactly the same as the slides. So it's not 3,500, it's 3,800, 3,800, like this. I want to be exactly like slides, otherwise there's going to be confusion. So let's repeat again. If the company expect to get cash at the end of the life of the asset, you deducting whatever you're expecting to get from the calculation of your expenses. If you get 0, then this deduction here will be 0. We're going to talk about this on the next time when we start talking about the long-term assets, and we're going to do this calculation. Only for the purpose now for this this exercise, I want you to understand that we have to transfer the cost of the assets into the expenses to match the revenue that we're generating from that particular asset, but only to the amount that we actually expensing. So if we get cash at the end of the life of the asset, we have to deduct that cash from the purchase price of the equipment and amortize. That's how it's called. It's called amortize. Amortization is transferring the cost of the asset over the life of the asset as an expense. That's called amortization. And then we're getting the amount that we have to amortize per year and per month. So for the month
So
of
I have a
January,
question.
yes, yes.
That like in the second situation, in case that we have already record the depreciation for equipment, like the first one, and that I don't want to change that value. So can I record 3,800 as the revenue?
No, no, you have to get it correct.
Yes.
There's no options for mistakes. If you make a mistake, then you have to correct your mistake, but not the way you show me.
Okay, because
Okay,
that
that will change the entire picture. That's gonna show the people that you're making revenue, which you actually don't make. You made a mistake. Make sense?
Okay, yes, thank you.
Right? If you make a mistake, fix the mistake. Don't try to show the revenue, which is not revenue. That will be too much misinformation for the users of the financial statement. So the question is, here, why did we did all this exercise? To get to this point. What do I need? I need to get this amount here. Why do I need this amount? Because I use the asset for the month of January. Remember? For the month of January, we use the asset. So the question is, how much I have to add to expenses? Because I use my equipment, $850. So now we can go back to our chart here. And since we know that how much we have to add as expense, let's add those expenses. That will be minus 850. But we have to get it from somewhere. What we gonna get from where we gonna get it? From the equipment. Our equipment value is gonna go down. With how much? With the same amount. And we are in balance. 0 here, 0 here, 0 here, 0 here. Another 0, and all the zeros.
Professor, the
Yes.
$850 that we are paying, it's an expense made for the equipment, or
No.
these are the sales?
This is neither sales, neither expense. This is the equipment we're using to generate the cash, the revenue, correct?
Yeah.
But since we purchased the equipment and we already pay for the equipment, and sitting as an asset, we have to show that that asset actually being used for the purpose to generate revenue. So we have to reduce some of the value of the equipment and show it as expense.
Okay. So
Make
like
sense?
due to
So
maintenance, like is
no,
it
it's not due to usage.
okay?
Question for you. You bought your laptop, correct?
Yeah.
So you pay, let's say, $2,000 for the laptop.
Okay.
Let's say you're not using your laptop at all. You don't like it, you don't using it. Most
Yeah.
likely that laptop never gonna generate revenue for you or benefits for you, correct?
Yes.
So, but let's say you using your laptop and you're doing accounting for the person and you
Yeah.
start generating revenue. You're using your laptop and you're generating $200 revenue.
Okay.
Do you have expenses? You don't pay yourself salary, you don't, you using public internet, you using daylights, no rental, nothing. Do you have expenses?
No.
What do you mean? You didn't use your laptop?
Yeah, I did.
So how you gonna show the fact that you're using the laptop to generate the revenue?
Mm,
By transferring the cost of your laptop as expense. Make sense? Otherwise, it's always going to look like I'm only generating revenue, there's no expenses. But that's not true, because if you don't have the laptop, you cannot do the accounting. If you don't
yeah.
have the laptop, you cannot generate $200. The only fact that you generate the fact that you have the laptops helps you to generate the $200. The question is, do you have expenses? Yes, you do. Why? Because you're using a laptop. So now, how can I get the amount of that expense from using the laptop? That would be the other question. And the other question would be the answer will be very simple. For how many years you're planning to use your laptop? Let's say 5 years. Okay.
Yeah.
So 2000 divided by 5, what's going to happen then?
400?
Divided by 5 is going to be 400 per year.
Yeah.
Divided by 12, $33. So
Yeah.
every month when you're using your laptop to provide services, which gonna give you revenue, you're gonna deduct $33 as expense for using your laptop. Make sense?
Okay. Yeah.
Is that
So
is that fair?
yes.
Yes.
So if I decide to sell my laptop at the end of 5 years, I should be getting the amount that I got, right? Calculated.
So technically, no. So technically, so watch this. If you decide to sell the laptop, when you buy the laptop, you can say, okay, I'm gonna use my laptop for 5 years. At the end of fifth year, I'm gonna sell it for $200. So
Yeah.
now you're not gonna transfer as expense $2,000. You're gonna transfer expense over 5 years, only $1,800.
Correct.
Make sense?
Yeah.
Okay. We're gonna talk about this next time again.
All
Let's
right.
do the
Thank you.
other two transactions and let you go. Sorry, I'm gonna keep you a little bit longer, just to finish those transactions. We're almost at the end.
Sorry, I have a question.
Yes,
And how about the depreciation expenses?
it's expense.
We are using some equipment.
Yes, that's what we did here. That's what we did. We're increasing the expenses
Okay, thank you.
and reducing the value of the equipment. That's our depreciation expense here,
Uh-huh.
right?
So
We
why? Uh-huh.
yes,
So expenses is the same with depreciation expense?
yes. Depreciation expense and expense, that's expense,
The same. Okay, yeah.
right? And next time we're gonna see how we're gonna call this when we're reducing the value of the equipment.
Okay.
Let's do another one here. This is the rationality of the transaction number 5, and that's how they come up with 850 for the amortization or depreciation expense here. Again, they know that $3,800 is the amount that you can get at the end of the equipment, and they're working out to get the 250. So let's go with our insurance. Remember, we purchased the insurance on January 1st. Let's see what's going to happen with that insurance. Now, if you remember, we purchased the insurance on January 1st for $1,800 for 1 year. But January already gone. Make sense? So now the question is, let's bring this one here. And let's put it on the new Excel here. We purchased this insurance for 1 year, from January to December 31st. We already have 1 month pass. January is gone. Did I use the insurance?
Yes.
For how long I use the insurance?
1
For
month.
1 month.
For 1 month.
1,800.
So what I have to do? I have to get how much is the insurance?
Total amount by divide by 12.
Per month, yes. So how I'm gonna get it? Insurance per month will be equal to $1,800 divided by
Divide by 12.
12.
150.
Oh, it's gonna be 1,800 divided by 12. $150. So every month I have to transfer $150 as an insurance expense. And since the month already gone, let's do this. What we're gonna have? We're gonna have insurance of $150. Now I have to reduce something, which I'm gonna reduce. How much is my prepaid insurance now? My prepaid insurance on January 1st was $1,800, right? So $1,800. And how many months I have to use this insurance? How many months I have available to use this insurance? 12 months. So January, February, and keep going until December. And at the end of December, how much should be my prepaid insurance?
0.
Zero. So how much I have to deduct every month?
1,800.
150.
150.
150 every single month. So if I do that, how much will be my balance at the end of January? This one plus that one, correct?
6,650.
And every month's gonna go down until it goes to, sorry, that's not the one. So next month will be equal to this one plus that one, and now it's gonna work. Until it goes to 0. Make sense?
Yeah.
Okay, so now I have to reduce my insurance, minus 150. Prepaid insurance goes down. And one more transaction I have to record the interest expense on the bank loan. What's happened with that interest expense? When we borrow the money from the bank, let's copy this and move to the new Excel spreadsheet. When we borrow money from the bank give us those money with 6% annual interest. Can you see it?
Yes.
So the question is, if I borrow $100,000, and my interest is 6%. How much is my interest per year?
100,000 plus 6%.
Right? That will be 100,000 times 6%. So my annual interest expense will be $6,000. How much is per month?
Divided to 12.
This one divided by 12.
12.
So that will be my monthly interest expense. Did the January pass already?
3 months.
January pass, right? So the bank wants me to pay my interest. Let's go and show it. If the bank tells you that you have to pay interest at the sorry, it says in the question, by the way. When do I have to pay the interest?
3 months.
Every
Between
3
3
months.
months.
Every
Yeah.
3 months. So at the end of January, do I have to pay interest?
No.
No,
No.
not yet.
But do I have interest expense?
Yes.
Yes. So let's show those $500 interest expense. Minus $500 expense. And what's going to happen now? I'm going to have new liability, which is interest payable. Interest payable.
Okay.
Make sense?
Yes.
And we're done. Finally, we're done with this. Sorry it took me so long. So what we can see from here? We can see actually everything. From here, I can prepare income statement. Can I?
Yes.
How much is my income? Do I have my revenue?
Yes.
Yes, sir.
How
34.
much my revenue? My revenue is
34.
34,000.
34.
Do I know my expenses?
Yes, sir.
Yes.
26.
6,600.
How much is my income?
7,400.
Those two together, right? So once I get my income, can I calculate my shareholders' equity? What do you say?
Yes.
Yes.
Yes. How much will be the shareholders' equity? We're going to have a common shares or contributed capital, and the contributed capital, he contributed 250,000, correct?
Yes.
Next thing will be retained earnings. For the retained earnings, we need a new calculation, right? Remember? For the retained earnings, we have to do the calculation. How are we going to get the retained earnings? If you still remember, we need the beginning balance. Beginning balance was 0. Then we're going to add net income.
Net income.
Do I have my net income?
Yes, sir.
7,400.
Yes.
I have it. 7,400. And I'm going to deduct. I'm going to add net income. And I'm going to deduct less. What I'm going to deduct now?
Dividend.
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 Don't forget the dividend. Dividend. And how much was the dividend?
400.
400. How much my retained earnings at the end?
7,000.
7,000.
7,000. So that 7,000, it's gonna go where? Right here.
Retained earnings.
So how much is my shareholders' equity? $257,000. Make sense?
Yes.
So what I'm doing from here, I can prepare now the balance sheet. What will be my balance sheet? I'm gonna get those things, Control C, and watch this. I'm gonna paste the special, and I'm gonna go this way, values. And I have my cash, my accounts receivables, and everything. How much my cash? My cash is 13,000. Let's make it smaller. Then I'm gonna have my accounts receivables. Then I'm gonna have my inventory. Then I'm gonna have my prepaid insurance. Then I'm gonna have my equipment. And then I'm gonna have my land. So how much assets I have? I have assets for $367,000. Now I have to check my liabilities. Correct?
Yes, sir.
And I have those liabilities. Let's put them together. Go special, values, and transpond like this. So what do I have? I have accounts payable of 9,500. I have to pay interest $500, and I have bank loan payable of $100,000. So my total liability here is $110,000. And then what I have equity, which equity is equal to $257,000. Now the question is, my total equity and liability, are they the same? How much they are? So total liability and equity is 367. Am I in balance?
Yes, sir.
Yes. Once we're in balance, we are in balance. And we're done. Make sense?
Yes.
So now what I have?
Yes, sir.
I have my income statement. I have my shareholders' equity statement. That's a very simple statements, but you can see them. And I have my statement of financial positions. Everything on
Professor,
one place. Yes.
how did we calculate the share stockholders' equity? If you can repeat, like just the values.
Here the stockholder, first we're
Yeah.
getting the common shares, how much the
Okay.
owner invested initially, and then how much of the revenue, expenses, and dividend stays with the owner. So that means that we have to calculate this retained earnings,
Okay.
right? And retained earnings, that's why we're doing here. We're calculating the retained earnings. Retained earnings always start with the beginning balance, which in our case was 0. Then we're gonna add the income, and then we're gonna deduct the dividend, and we're gonna get the retained earning at the end of the period, which retained earning at the end of the period comes right here,
Got it.
right? So
Yes.
let me put one shape here. That's your retained earnings. From here goes here. I try to make it logical for you. So what the last thing that left for me is move those one around, and then we can put here assets. Sorry, not this one. That will be the insurance, and that will be interest, and that will be slides. And now I can save this one in my computer. Slides, template, and that's not now the template, that will be slides solution. And I can post it for you so you can have it. And let
You
me
can
show
have
you.
it in the bright space.
Yes.
Oh, thank you.